Morning, everyone, and thank you for inviting me for this subject, which is very close to my heart. And so, when first time I got this call from Ketan Bhai that this is some series, Bhagyoday series he wants to start, and he says apart from subject, we also want to understand your life journey, how to get the work, how to charge the fees. I said the first time I sat back and wrote something on this subject. Otherwise, I take a lot of classes on valuation, but I stopped there and but I never summarized my life journey. So I must thank WRC and Ketan Bhai and the team for conceptualizing this, and maybe it also gives me some kind of a signal that there is time for me to also retire. Because when you start writing about your life journey, you realize that maybe God has given you much more than what in terms of knowledge or in terms of sharing of whatever you have learned in life, much more than what you deserve. So you have to look back and introspect on this. So very different theme. And so what when I was planning this entire session, and I realized that it is a almost a 3 hour session. So I thought I'll shift between the subject and the life journey, of course, while explaining the valuation. But there are some at the end of the first session, which I will keep about 50% of the time, where I'll concentrate more on the subject, and balance 50 or 40% of the time will just understand on other aspects of relating to this practice as well as this subject and this area, and what are the issues which may come up if you start this practice and how to mitigate those areas. So that's intention. Not sure whether there's any break in between. So we'll continue like that. And wherever on the subject you have any questions, we can take it up maybe at the end of first session. So we'll be done with the subject and then we'll start other one, or on the while on the slide you may also stop me, and whatever is convenient we can. I like teaching to a group which is manageable like this, because it is very important to personally interact. This subject is not something which is like a normal reading and understanding. It requires a lot of interaction in terms of personal experiences, personal examples of how you have dealt with a situation. So it's always better to interact with people and the participants. I don't claim myself to be an expert on the subject, although introduced like that. I'm a student of this subject. Every day there is a new learning. Frankly, you have to unlearn something and learn something when you are in this subject, and that adaptability is definitely required when you are in this practice. So it's always your mind has to be always open to keep on learning new things. I had registered tomorrow for AI course, but unfortunately I had to drop out because of some professional engagement. But I'll take this up again in the June batch. Otherwise, there is a 3 day batch of AI starting tomorrow, which I had enrolled. Subject which was new to me, but every board I sit at, there is a discussion on AI. So I thought, let me understand this subject, and I had enrolled, but somehow because of the commitment, some professional commitments, I am unable to attend. So we'll go by this. Any suggestion you have, or anywhere you want to stop me, please feel free to stop me. So as I mentioned, we have divided this into two sections, the whole presentation. We'll first speak about the valuation, how this whole field has evolved over a period of time. We'll also take some slides on the subject per se. Any one of you have done a registered valuer course out of this batch? You have done already? Yeah. We have met somewhere, I think. I've seen. Rupan's cousin, so oh yeah, we have met. Yeah, okay. Yeah. So your face is very good. Yes, nice. So there is a entire new requirement now for the valuers how to register. I will explain that also. We'll also cover some part of the valuation methodologies and some concepts, and some of the issues which are in practical life we face. That will take care of the first part of the session, and entire second session is like a free journey where I will I will whatever journey I had in this field, I will explain how I got into this field. It is a little uh, something which was not planned journey, but I'll just explain you how I went into it, how the skill needs to be established, and how we can enhance or sharpen our skills on these subjects. There was also one of the requests from the organizer that we must discuss about how to get this work. Where is this work originating from? So I've covered that also. How I think, as Ketan Bhai mentioned, how the fees are charged, particularly for this area of practice. And there, in the last slide, I'm covering some of the very uh, pain areas in valuation. I would not call it, it sounds a little negative, but some of the areas where we'll have to be little careful and how to deal with it as a practitioner who is not from a very big organization. We are vulnerable to so many attacks from outside. So how to withstand those attacks, I am covering in those slides. So this is how we will cover this journey. Now, how this entire valuation, so maybe let me just go back to the history. Prior to 80s or 90s, there was no formal regulation on valuation prevailing in the country. And valuers were like homegrown valuers. Certain firms which were very dynamic started this area of practice. And in terms of timing, the major area of work in valuation started flowing post 1991 when India opened up the economy. The kind of work which started coming into the firms which were already into the valuation. So large Indian firms had that time not a very dedicated area, but one individual partner used to handle this area of practice. And in those years, either courts were appointing valuers, or there was a requirement by some companies for valuation when they were doing some merger or so. But major workflow started from post 91 when India opened up the economy, when the foreign exchange regulations also got changed, cross-border transactions started taking place. The stock exchange scam happened, so SEBI came into the picture. So thereafter, some kind of entire regulation started coming in slowly into the statute books. So if I really look at it, earlier there was a Veltex rules where that old asset minus liability formula used to work, and net worth based on that. So minimum rate at which you can transfer the shares. So we used to call Veltex rules prior to 90s, and institute had come out with a very brief publication on study on valuation. I think it was a 15 or 20 pager booklet where they had explained the methods of valuation and all that, some 2 3 methods, and how valuations were done. Then CCI guidelines for public issues. That time when the pricing became little free, where CCI guidelines were there, you had to fall into the parameter of CCI guidelines that you cannot charge more than premium as derived by the CCI guidelines. Now those guidelines have been scrapped, but that time, of course, multiple valuation methodologies were prescribed in that, and there were mechanisms for value certain types of companies which were prescribed. So CCI guidelines was one benchmark. Post that, SEBI came into the picture 1992, and SEBI, of course, Act has evolved over a period of time. But initially, it started with certain regulations where valuations and other things were there. Nowadays, oversight of SEBI on the valuation has increased substantially. For any company which is a listed company, you have now seen an entire different process being followed. Earlier, it was not so acute. It was more handed over to the stock exchanges. Stock exchanges were either approving or asking questions on the scheme, and thereafter, SEBI, now current practice, what is being followed, I will explain you when we come to that particular thing. Then FEMA regulations were the first one which got changed. In old FEMA regulation, they prescribed that DCF valuation will be allowed. Now, prior to that, I think came in 2010. Now, prior to 2010, India had never done valuation based on DCF valuations for deals, particularly. When regulator himself brought this into the statute books, frankly, all the valuers had to rush to understand this method in detail, because only few were practicing this method. And I remember prior to 2010, when this FEMA regulation, where DCF was recognized as an acceptable method, once I was called by a regulator. We had done some merger because of no past history. We had used future projections. And I was called by that time ROC's office used to go through all the mergers and they used to pass. So I was called by the regulator and said, "What is this method? How can you use a method which has a future projections and all that?" And I think it took me two meetings with him to explain him the methodology and how it is being practiced and why it is not irrelevant method, how internationally this is very commonly used, and thereafter it was accepted. But after DCF being introduced in FEMA, it became little easier, and thereafter the knowledge on the subject also increased substantially. Prior to that, I remember my guru or boss that time had brought one book from London when he used to travel to London because of work purpose a lot. So once in one of the stores, he found a book written by McKinsey and Company on discounted cash flow method, and he had brought, and we studied the entire book and we developed the model using, at that time it was not this Excel, it was Lotus 1 2 3, and so and lot of things we were manually doing. So I remember reading the entire book. 50% of the book we could not even understand the terminology, but thereafter it evolved over a period of time, and we learned that new method also. Otherwise, prior to that, only method which was used other than the net asset method was the price earning multiple method. We used to apply multiple to profit after tax after removing non-recurring items of income or expenditure and apply PE multiple, and it was much simplified way of working. But when DCF came, lots of new challenges came to the valuation field. I would feel between, if we have to really think from the valuation perspective, prior to 2017 era and post 2017 era, we can put this into two different baskets. Come 2017, the Companies Act got amended. Of course, the section was there, but section got notified, and registered valuer was the first time it got introduced, 2017, and I think some part in 2018. So, so that was the first time where certain transactions, which if you are doing under Companies Act, valuation has to be done by a registered valuer. That situation came in. India had that time no registered valuer. We had to appear. After almost that time, I was 25 years in this practice, and I was hoping and praying to God every day that regulation will come, that those who have had more than 20 years experience are exempt from appearing for exams. But that was not my luck. So I had to appear for the exam, and 2018 was the first batch by CA issued under our RVO, Registered Valuer Organization, where we had a 50-hour training at the ground floor auditorium, and we had to appear for the exam immediately thereafter. Once you have this 50-hour certificate, you have to attach that certificate, apply. That time stock exchanges, I'm not sure now who is conducting the exam, but that time we had to go to Bombay Stock Exchange, and there was an electronic exam, and by that time you enter the final click, you are aware that you passed or you failed. And the you know the now I laugh at it, but around fourth, the 50-hour batch was about seven days course. So at the fourth day, I receive a call from ICI Delhi that you have to take the session on the sixth day. I said, I am a student. How can I take the exam? I can take the session because I'm registered as a first student, because everybody had to pass the exam. But they said on this subject we have no speaker, and you have to appear as a student, but we will exempt you from that, and you have to also give the session, take the session. So maybe it's a unique case where as a student I had to also take the sixth session of that course, and you will be laughing at me, and I must accept my sort of inability. I had cleared the exam in the fourth attempt. Although maybe in that time I was the person who had the maximum experience in the field of valuation, and we had no background of what kind of questions will be asked. It was the first batch, first set of exam, and nobody knew. So we were prepared for valuation, but all the questions were non-valuations. Contract Act, Sale of Goods Act, and we had forgotten that during the CA exam, we used to read it, but we had forgotten it. Not that we had no session on that. We had a session, but we thought we'll ask this. How many days you have to raise this, and how many days you have to file complaint and all that. We had forgotten, and most of us failed. And I, being a slow learner, I could clear the exam after fourth. So when I left for my home, every student who appears for 10th standard, my mother and wife gave me the dahi with some shakkar saying that I hope today you pass. Otherwise, every day you are getting up at 4 o'clock and reading something, and then you will call from the Bombay Stock Exchange that I have failed. I was so much ashamed that the fourth attempt, if I don't pass, I don't know what I would have done, but luckily I passed. And Dahi Sakkar worked. So I passed the exam. But point I'm saying is that one cannot claim that he is an expert, he knows everything. You have to also adapt to the situation. And the third attempt was my bad luck that we lost electricity. Very rarely, Bombay Stock Exchange and our computers went off. Luckily, with me, my other colleague Paras Savla, you may be knowing, we were together and we said, "What is happening?" Our entire screen went off. And that was some unusual day. 1 hour the light was not there. And when it restarted, we had only half an hour left for finishing the paper because it was electronic, it was centrally managed. So, and we could not pass. So I got 59 and a half or something, and Paras got 50, 15. He was more than me, 59.75 or something like that. And we failed for a very small margin. So, but that was a technology issue. But otherwise, in the fourth attempt, so point I'm just trying to convey that I don't think so. Anybody can claim that I know this subject and I am a king of this subject. One has to be a learner, and we had such a terrible practical examination in that practice. There was a case study, and we had to solve it. No computer Excel was opening in that exam module which was given. No calculators were allowed. So lot of things manually we had to do, which we were not used to. By that time, we had lost this calculation and all that. So anyway, it was a learning thing. I believe now situation, those who have appeared now, situation must be much better. But we were in the first batch with no background. So it was a good thing. So I gave this example in every speech I give that I attempted. I don't feel ashamed to say that I cleared in the fourth attempt because that will give you something, some message that every time you have to keep on learning more and more to achieve something. So 2017-18 this came. Now IBBI is the agency which is monitoring this whole registration. ICAI RBO. So we like that we have around 14 RBOs in the country. So Institute of Company Secretary also has their own RVO, Registered Valuer Organization. Likewise, we have 14 RVOs. ICAI RVO is one of them. For us, member of ICAI, it is a very smooth process. Because you are also a member of ICAI, you connect to ICAI RVO. It is not compulsory for you to connect to only ICAI RVO only. Being a chartered accountant, we had people who had registered with Cost Accounting RVO or Company Secretary RVO. So it is not compulsory because ultimate registration is with IBBI. Today, if you go to Insolvency and Bankruptcy Board of India website, you will find a list of registered valuer. You go through, there is a section called registered valuer. You will find all the details of who have registered and which date you got registered. So it is something which is now public knowledge. So who is registered valuer is readily available. So as we speak, we have 14 RVOs which are registered by IBBI. We have about 120 registered valuer entities. When I say entities, SSPN companies are registered as a registered valuer entity. Likewise, you will have Deloitte Private Limited or XYZ is registered entity. Like that, 120 have registered in the country. Total registered valuer today, again, it's a dynamic number. Every day it changes, but it's about 5,800 registered valuer in the country. Out of which, in the securities and financial asset segment, we have about 2,270 odd. Latest number I don't remember, but about 2-3 days back I had seen it was around 2,200. Almost 50% of registered valuers are securities and financial assets valuers. So our group, basically, we are not entitled to be a registered valuer in the field of plant and machinery land and building, and other assets. We are, as of now, because we don't have engineering degrees. So as of now, we are entitled only for SFA segment, as we may speak, and that's where we are the maximum in number out of 2,200. If I am not wrong, because that data is not available, around 1,500 to 1,600 will be chartered accountants. So we are today, so from a complete monopoly of chartered accountants to do valuation in this segment, now we have competition also, which has opened up a lot. Nothing wrong in competition. We'll deal with it, how to be on the top, continue to be on the top. But I'm just saying this is how now you are competing with MCOM with 5 years experience. Now you are competing with MBA. Now you are competing with cost accountant. You are competing with company secretary. You are, I think, competing with some other finance degrees. I'm forgetting CFAs. Yeah, CFAs, and so there are now whole other bunch of professionals who have also come into this field. As we speak, the entire statute book has not changed to registered valuer. Time is not far where every regulation will ask you to be a registered valuer to carry out the valuation. Today also under the FEMA, any chartered accountant or investment banker can do the valuation. Under income tax, still it is an accountant, so only chartered accountant is required, or investment banker at some places. Right now, all the regulations have not changed. Companies Act is the first one to start with. SEBI is the second one. SEBI for certain transactions have insisted for registered values. Time is not far where FEMA will change. You will see change in income tax also. All regulators will align itself that any valuation which is required has to be done by a registered valuer. So those who are not registered valuer and you are even 5% interested in this subject, please at least finish this exam part of it. It is much easier. You keep your register, at least your eligibility ready. When you want to register, why you want to register, why you don't want to register is a separate section. But at least make yourself entitled to register, because there is also another movement which I think I have written as the last thing. There is a valuers bill which is coming up. During COVID time, government introduced this valuer bill. So like a CA institute, we will have institute of valuers. A different regulator, different act will come only for valuers, and all of us will have to migrate to institute of valuers. And that valuer institute, the way the draft is coming from the government, will have all the valuers under one roof. The entire disciplinary mechanism will shift to that institute. So before that, if you are registered valuer, the provision was that you will have automatic migration to institute of valuers. Otherwise, you will have to again appear for exam as may be prescribed. IBBI, when it was given this charge of registering valuer, was only a temporary affair. That till the time you have a dedicated regulator, let IBBI handle this. But we are almost now 6-7 years down the line, and still IBBI is managing. So government during COVID period had introduced a bill. Somehow it has not seen the light of the day. But as there was a bill which was there was an intention which was known that government wants a separate dedicated institute for valuers, and it might come in shortly. Again, some FEMA changes which keep on coming about valuation, will not deal with it because I'm sure you are aware about it. Now let us go into the requirement under the Companies Act. Section 247 is the section which got notified in 2017, whereby what it says, valuation of property, stock, shares, debentures, securities, goodwill, all other assets to be done by a registered valuer. The appointment of the registered valuer will be either through audit committee, where there is an audit committee which is in place, or board of directors who are in charge of the company will appoint the valuers. Now, what is the 247.2 expectation from us as a registered valuer? We have to do an impartial, true, and fair valuation of assets. Exercise due diligence. Now, when this section was introduced, nobody knew what do you mean by exercise due diligence. So it is not the financial due diligence or legal due diligence, which is a separate area of activity of for professional which is being practiced. What they mean is that you have to be diligent while doing the valuation, and I'll tell you where you have to be diligent, because there are so many cases which are highlighted where IBBI and governments are not very happy with the way valuer gives the disclaimers. So that is where there is a pinpoint. They have come out with specific guidelines on this, that you can't disclaim everything, that projections were given by company. I did my mathematical thing and I have done the valuation. Now they want you to own up the projection. Now own up is not sign up. Own up means they want you to review the projections. If you are not comfortable, discuss with the company. Find out the reasons why company has assumed certain growth. Say for example, today my contribution level, that is sales minus direct cost, contribution level was 40%. Now suddenly in the projection I increase from 40% to 50%, 60%. You must have some reason. Now just because a client gives you 40% to 50% or 60% is not something we have to reject it, without getting into the details. When you discuss with the client, get into the details why he has assumed from contribution means direct costs, sales minus direct costs going up from 40 to 60. Now there could be some valid reasons. Now he has found a new source of raw material which is cheaper. He has maybe found a new source of manufacturing which has a much better process at a much cheaper rate. Maybe he has bought some machine which was replacing an old age machine to a new machine where requirement of direct labor was low. It could be variety of reasons. We will not be able to just reject on the face of it that 40% say 60% how you have taken, I am rejecting it. Get into the details, get yourself convinced that what he has done is right. uh, Something which is only a brainchild of a CFO. Sorry to use this word, but sometimes it's a CFO who makes the projections and gives us the assumptions. So I think in subsequent slide I'm covering it, that when you are given a set of projections, what are the things you have to look into it, and how you have to convince yourself that these projections are fair and reasonable. You don't have to sorry you don't have to sign off the projections. Nobody can today assume that what will happen after 1 year. We don't even know what will happen today afternoon. Whether we knew anything when 26 November incident happened 2008, that today tomorrow this entire hotel will not open up, nobody knew. Suppose I had valued Taj Kolaba on 25th of November 2008. On 28th November 2008, if same board of directors would have approached me that I hope you hold back to your valuation, will my answer be correct? I'll have to immediately withdraw my report, because in between the two dates an attack took place on the hotel, huge loss of property, many lives got lost. You don't know how much compensation they will have to pay, when they will be able to restart. So entire valuation of that property got changed. So that's why it is a very dynamic. I always say very valuation is a perishable item. Any valuation done, you do it as near the date of transaction, because all the things which have developed over a period of that time gets captured in the valuation. It is not that I can do a valuation in on say December 2024 and say it is valid today also. It is a highly perishable item. So, another thing which, if you see the fourth bullet, which the Act 247(2) says, that valuer cannot undertake any valuation of assets in which he has a direct or indirect interest, or become so interested at any time during period 3 years prior to his appointment as a valuer, or 3 years after the valuation of assets. Now, in real life, you know what this section throws up challenge for you as a valuer. Suppose I am a firm of chartered accountants and I did a valuation of, say, I'm again only for the namesake, I'm saying Hindustan Unilever. Now I have a partner who was involved there, and he leaves, or he or she leaves the firm. And after joining another firm, if she gets into a valuation of Hindustan Unilever for some other purpose, is that something which will violate this condition, that interested at any time during period of 3 years prior or after? First of all, after After 3 years, how you will be able to visualize also what challenges will come and who will do what kind of. So I had to sort of go to a law firm to find out what kind of, first of all, what is direct and indirect interest. There is no, unlike in audit, they've defined, I think 2% of the capital and all. Whereas in valuation, there is no definition. What do you mean by direct or indirect interest in the company? So suppose I am holding 500 shares of that company. Will that be considered as some indirect interest in the company? So as of now, what each valuation firm follows its own standards, that what will be considered as direct and indirect. Direct will be like my father is a CEO of that company, or my son is working in that company, or my wife is working in that company. That is a direct involvement. Or I am a board of directors member. These are direct involvement. But indirect could be many. So holding shares itself is an indirect. Or if I had done some assignment of taxation in that company, per se 2 years back, is it an indirect interest or something where I had some engagement earlier? So all these issues are open today. We do not have a very firm answer. What valuer community has done, everybody has designed its own rules and regulations, internal rules and regulations. On this subject, I have spoken to every firm of this country, not even city, that what are the things they are following. And everybody has a different nomenclature, different interpretation of this section. So each one of us will have to decide till the time clarification comes, that what do you mean by direct and indirect, and how do you deal with this, having some work before 3 years or after 3 years. So that is something which, and how do you control this as a firm? I don't know how my person will tomorrow leave this firm and where it will go. He may join Hindustan Unilever itself. Who knows? So that is something which as of now is open, but I think it will evolve. Till that time, most of the firms are following this 2% criteria. That till the time I don't hold 2% equity of the company, I am not considered to be directly having any interest. So this is the structure of the regulation as we speak today. You have a IBBI, which is a master body. Then below IBBI, you have RVOs, and below RVOs, you have members. So first set of disciplinary action is by the RVO, and if beyond RVO, it is IBBI. On the IBBI website, there are so many orders which are available. You can read it, where disciplinary actions are taken against the valuers for some misconduct. And it is something to go through it, because there are so many incidences where they've considered a member to be sort of guilty on certain grounds. So we must go through this orders in detail. But structure wise, you have IBBI as the top body, you have RVOs. Today in India we have 14 RVOs registered, and thereafter below them registered valuers. Each RVO have different sets of, so company secretary RVOs will mostly have company secretary members, but they have gone into value. So now we have valuers from company secretary community also, cost accounting community also, so everyone. Now, another thing which our institute was the fastest to come out with in valuation standard. Everybody was struggling because till that time everybody was following international valuation standards. There are valuation standards of UK, you have Australia, you have USA. Every country had their own associations or institutes who had come out with valuation standards. But the day our regulation was enacted, CA Institute amongst Indian associations or institutes was the first one to come out with its own valuation standards, which were adopted by our RBI. So again, the whole purpose of having a valuation standard like accounting standard is to have consistency, standardization of the way valuers function. And for practicing chartered accountants, if you are registered with CA Institute, you have to follow this standard after 1st July 2018. And if you are a non-chartered accountant, you are not bound by these standards. However, by practice, I have seen many valuers who are using this as a standard who are non-chartered accountants. But for us as a chartered accountant, if we are member of this body, we have to follow this standard, valuation standards. Now, which are the valuation standards till today which are published and which are enacted? And as Ketan Bhai mentioned or Jinal mentioned, I was very fortunate that I was one of the team members who was involved in this exercise. So it gave a huge learning experience. I must honestly tell you that setting up a standard or even drafting a standard for an institute itself was a huge experience which we got, and it of course it brought most of the valuers of the country on one table, and it was a really good exercise. Huge. We same building we used to sit till late nights to draft those standards, again get it, read it, reread it as a group, and everybody was assigned certain standards, and we used to individually draft, then again discuss it as a group, then it was discussed at the council level, and then it must have got approved. But huge experience. So we have valuation standard of definitions, valuation basis, approaches and methods, scope of work, analysis, evaluation. These are all different standards. Reporting, how report needs to be drafted, documentation, business valuation is the overall standard, intangibles is one, and financial instrument is other. So we have, as of now, institute I believe is also coming out now with the valuation standard on the land and building and other immovable properties. Because we will be happy that now our RBO, ICI RBO is also recognized to register valuers from non-financial field. So we will have, come tomorrow, we may have land and building valuers also registered with ICI RBO. It may have passed the exam from some other institute, but our RBO is now entitled to. So RBO is now gearing up for that. Now let us start something. So we'll go little on the subject. I will not spend too much time on the subject because I'm sure some of you have decided to attend this course, so some background knowledge is available. So another one concept which we have to be very clear in the mind is that value and price could be different. I may value a company at say 100 rupees a share. It is not necessary that the buyer will buy at 100 rupees only, or the seller will do the transaction at 100 rupees only. I don't think so in my lifetime I have seen transaction happening at the same rate at which you have given the valuation, unless it is a valuation which is prescribed for mergers where your swap ratio ultimately either they have to accept or reject it. Otherwise, for a normal fair valuation, you may give a fair valuation as per your opinion, but the buyer and seller could have different motives. Buyer could be extremely aggressive, he wants to accept a monopolistic situation. Seller could be in distress, or seller wants to have some other obligation to be paid off, so he's selling these shares, so he wants to finish it at a fast time. For that, he may offer a discount. So there are multiple reasons why price and value may not match, and that's where sometimes I used to, in the initial life of my practice, I used to get really pissed off with somebody doing a transaction at rate different than what I had suggested. But then I realized that our job is to give a fair valuation as per our opinion. Another thing which, as a professional, we must keep this in mind: this is an expression of an opinion. This is not a certificate. Many valuation report which comes for my review, I see certificate of valuation. Valuation is an expression of an opinion. It is not a net worth certificate. You can certify a net worth, but for valuation, it is an opinion. So your end paragraph should just say, in my opinion or in our opinion, fair value of the company is so. Because ultimately we'll come to when we go into more details, there are so many items which are very subjective in nature. You will not be able to have a absolute definity. In this entire class, if we give the same set of data, I am sure we will have 25 valuations. Nobody will come to a common valuation unless somebody copies the paper. But otherwise, it will be different only, because you will, for contingent liabilities, you will use different probability. For your discount rate for projections, everybody will have a different view. For P multiple or EBITDA multiple, everybody may use, you may have set of 5 companies which will be used as EBITDA comparable companies. He may have another 4 companies. Now, only point we have to keep in mind is we cannot select companies which suits us based on the final target which is given by your client or anybody. It has to have a logic. So suppose you are valuing a cement company in the landlocked area of say Madhya Pradesh. You cannot take comparable companies which are only into cement exports, which are located near the ports, because landlocked area of cement companies has to sell into nearby areas because it's a commodity. Ultimately, it has to be transported. So there are cement companies which are located on the ports, which gets a much better margin. Whereas in the cement companies which are in the long landlocked areas, because limestone is available in the Madhya Pradesh and Uttar Pradesh to some extent, and some places of Gujarat. So you have a very limited availability of limestone. So you have to have cement factories nearby. So when you select a comparable company, you have to select a company which is comparable. If I'm valuing a pharma company, say I'm valuing a pharma company, I take Glaxo as a comparable company, but I'm valuing an Indian company with a very limited research base. Glaxo has a huge research backup somewhere in the UK, which is providing continuously providing to the Indian legal entity. Whereas here you have an Indian single product, maybe only API. So you have to just find out the company you are valuing, which are the other comparable companies. Now your software is available, but those who can't, you don't want to invest in the software in the initial phase, there is available marketplace also, a lot of free data is also available. While we are on this data, one thing we have to keep in mind that if we take up any assignment and you go into internet, you can get lost. So much of data is available. You have to really remain focused that what data to concentrate. Otherwise, you have a 15 days assignment. On the 13th day, you will be struggling how to which data to discard and which data to use. So sometimes you have to, unlike audit where senior goes in the end for finalization, in this valuation practice, seniors have to take a continuous everyday review from the juniors. Every day you have to make sure that they are not off the track. If the train goes off the track, to bring it back on the track is going to take a huge time. So I can't go on the 14th day and say tomorrow we have to issue the report, show me your calculation. It may happen that they've selected completely wrong set of companies. They've completely taken a wrong method of valuation. So you have to continuously be on the scene. You have to continuously also remain in discussion with the client. It can't happen. Again, I'm not saying that auditors do like that, but I'm saying in audit, you can afford to do that because you have a set rules, set procedures, set softwares which are available where seniors can only review that. Whereas in valuation practice, one has to be completely on the top of the assignment every minute. Okay, we slightly digress. It is not an exact science, it is an art, because every individual will use its own judgment. Only my humble suggestion at the cost of repetition, don't use parameters which just suits you for the ultimate goal. Your parameters, what you choose, has to be something which you are convinced of. And why I'm stressing it, because tomorrow if regulator will call you and there is an investigation on your valuation, your conviction about the parameters which you have used only will help you to defend your case. You cannot say because I had only 2 days, so I could do only this much research, and that's why I cannot be expected to do too much because I had so much of time available. What is expected, because all these things when it opens up, it will be after 2 years, 3 years. You will not have the preview of the same employee who has helped you on this assignment. He may have left, he or she may have left. Only file will speak. What will help you only is your documentation. Because after 3 years, you also keep forgetting why I chose this multiple. The backup has to be very, very speaking backup. So, like audit file, your valuation file also has to be extremely up to date. Anytime you are called, and sometimes you are not given a day to appear. Huh? These regulators, when they call you, it is tomorrow morning 11 baje aa jana. Now, first of all, you have to go to the godown to take the file. So that kind of pressure is put, and you have to defend, and you can just imagine the person who has helped you is not around. So you have to take the whole thing. Person who has signed is almost like hanged. I have gone through multiple such things, and again I can say this today in a lighter mode, but the pain and the kind of efforts which you have to put in if something like this comes up is unbelievably high. Again, I'm not trying to say that this field is having this risk, but you have to be extra. This is there in every field now. You have to be on the top of it. So how to improvise and keep your document in such a way that go tomorrow morning 11 o'clock I'm called, I'll go with the file. My file is a speaking file. Every parameter you have used has to have a backup, write up why you are convinced that what you have done is right. Then if it is subjective, nobody can challenge. It is my opinion and I have this logic. Somebody to defend and sort of oppose that requires a much larger skill set or much larger database, which is little far off. As I mentioned, valuation is a date specific thing. It becomes outdated the moment we leave this room. So, and valuation varies with situation to situation. For amalgamation, my entire focus shifts to relative valuation of the two companies. It is not necessary that I have to use the same methodology when I do amalgamation. So if I'm merging, if I'm called to do valuation for merger of say Pfizer and Park Davis, it is not necessary that I have to use same method, same multiple. No, what is expected is that it is a relative valuation. So I can't say that for one I have used DCF and one I have used past data unless there are compelling reasons for me to do that. So for example, I am having a merger of an NBFC with a pharma company. Theoretical example, not possible in the current regulatory environment, but I'm just throwing this for igniting the thought process that if I have a pharma company, I have a NBFC. NBFC, the most of the NBFCs are valued using price to book multiple. So if I have a book of 1,000 crores, say 2 times or 3 times, depending on the quality of the NBFC and the underlying margins. Entire finance field, banks or NBFCs are valued. What is your gross differential margin? That means the rate at which you borrow the funds and rate at which you are able to place it. Suppose HDFC Bank today is the highest. Why HDFC Bank is today enjoying more than maybe 5 times, 6 times of price to book, whereas State Bank or other government banks are only 2 times or 3 times. That is the difference. So NBFCs or pharma companies, my methodologies could be different, but I cannot have different parameters that for one I use DCF, one I use this. Secondly, I can have different weightages assigned to individual companies, individual methods, and I must have a logic of it. But it is not. There is a confusion in the valuation community, that valuers community, that you have to exactly use the same parameters when you are doing a merger. No, I have series of discussions with the regulators also on this subject, that when your people are reviewing you, please do not assume that when I'm doing a merger of two companies, I have to use the same parameter. I'll give you a simple example. In both the companies are listed company. In one company, it is a thinly traded share, and one company is fully properly traded share. I may choose to give a lower weightage to market price in that case, which is a thinly traded share, vis-a-vis a normally traded share. So that is a prerogative of the valuer. Regulators will not be able to tell you that you use the same weightages. If I am giving 40% weight to market price for company A, I have to use same. No, if I can choose different, but I must have a reason. I cannot change the weight because I want to ultimately achieve a result. I can change it if I am not convinced that 40% weight for company A is proper. So that when I speak about documentation and the reasoning, I mean this. This note that why I applied lower weightage and higher weightage for another case, you must have a proper document. Now, what are the different types of assets for which valuation may be required? Again, not done by us as a CA community. We are only into one or two baskets, whereas others are available to only other types of valuers. So, securities and financial assets, CA. Business, CAs. When I say sorry, CA, no, person with financial background. Now I cannot use CA as a intangible assets. Person with financial background can do it. Land and building, no. Plant and machinery, no. Jewelry, no. Drawings, paintings, no. Sculptures, no. So what are the fields available to us? And friends, this is not an exhaustive list. This is only an indicative list. And while coming to example, I'll tell you to my utter surprise, a fellow chartered accountant took a literal meaning of something which I had shown in one of such seminars. And from that day, I realized that I have to put that disclaimer that these are only indicative. And I'll come to that because it's a very interesting and nothing wrong about that individual. In fact, in the arbitration petition, he has written that Mr. Sujal Shah in the WRC presentation has used 7 times EBITDA multiple, so that is fair. But the whole company was different. And I was somehow, he came for my opinion that I have given this submission to the arbitrator. And arbitrator is not accepting. Arbitrators want Sujal Shah to give it writing that 7 is the right multiple. I said, I can't give this in writing. But the point is, sometimes you are taken literally by the participants, so one has to be very careful. Yeah. Now, what are the purposes for which valuation is a trick? You have a question?
I was having, that's why I asked in case between we have to ask.
Yeah, you can ask.
It's okay now. We continue whenever we will have, I will raise my hand.
Hopefully, by the end of it,
There was
question.
one question, when you talk about the actual example and then you gave the answer कि equity share होगा तो ही वो direct relation है about the indirect and
Yeah.
indirect. So basically, this is the major the valuation department rules and regulations should have a definition of direct. This is
Yeah, they have not
very
yet.
important. Even I was
So in the
talking-
auditors, they have given this 2%. If you are holding more than 2% equity of a company, you are direct. Whereas in valuer, they have not clarified.
This is something important, very
Very-
important. So,
So there are
company-
representations which have gone. So CA Institute also has made a representation.
Since 2000, even I was in my articleship,
Yeah.
I was working in the insolvency.
But somehow, maybe the next round of change, they will clarify this.
So, it is 10
But
years
till
down.
that time, in a way, it is good that till that time you make your own rules, which are reasonable. You can't say I'm holding 25% of the company and still I'm impartial.
Well, this equity is your, as per you have defined.
So as I mentioned, every firm has defined their own mechanism of what is direct or indirect. So every firm follows it, keeps it in the rule book that everybody has to follow this. So today, if I am doing Hindustan Unilever, I'm not required, as per my firm's rule, I'm not required to divest, but I can't buy or I can't sell.
Chartered accountants, have they defined this relation?
For valuation, there is no separate clarification.
ICI,
Yeah.
ICI के rules का follow करें. Is there any specific?
No. The rules have not specifically come out with any solution yet, but I think it will evolve. This entire field, madam, is an evolving field. We have not yet reached a maturity stage. Every day there are new changes, new developments. In fact, that's why I'm saying you must read IBBI orders because now they have seriously targeted the disclaimers what we write. They are saying you are disclaiming everything as if you have not done anything and you are putting everything on the management of the company. We don't accept this. Now, that is something which is very serious, fundamental that my institute tells me that you can't be a party to a projections. And there they are saying you have to drill the projections and satisfy yourself that projections will be achieved. Now, we have to find a fine balance between these two requirements. Being a CA institute member, what IBBI in a way expects from a valuer, there has to be a fine balance which we have to reach.
IBBI's judgment may rule out CA's now. IBBI's
No, CA also is an institute by act of parliament. IBBI is also like that. But unfortunately, today we have multiple regulators managing us.
My principal being an RP always used to teach me IBBI is a god, whatever.
Yeah, so registered valuer, as I mentioned in that earlier slide, they are the. But my first connection is my parent is my ICI. शादी करके मैं गया हूँ IBBI but otherwise my parent is ICI. Yeah, so it's a very fine balance, and I have in the concerns for valuation practice, I have put this as a point that we have to answer multiple regulators. Problem is that we have no single regulator now left. Earlier, when I started my practice, my only answer required to be given was ICI. Now I have multiple regulators who can question me, who can debar me. Which is yeah. For registered valuer, IBBI is on the top right. But nothing wrong. I'm just saying Okay, you have to manage multiple rights. So I was just telling Ketan Bhai that I have to follow the CPE rules of ICI also. I have to follow CPE rules of RVO also. So I have to do two times CPE courses. So, in the process, sometimes you miss finishing those 20 hours because you are too much, involved in the finishing the other one. So anyway, so where is this entire area of valuation which gets triggered? So why you will be called to do a valuation? What will be the trigger point? Business valuation. Now you may be called upon to when there is somebody who is doing a merger, somebody is doing a merger, demerger, somebody is doing a slum sale of business, somebody is doing a subsidiarization. You will be called as a valuer. So first is a restructuring. Any current structure you are changing, it is called restructuring. So be company jaisa however whatever way it is being functioning, you are changing it. It is becoming a restructuring exercise, which could be merger, demerger, anything like that. So first trigger point could be restructuring of companies. Second, purchase or sale of shares or businesses. So you every day you read something in the newspaper. Somebody sold 50% stake to XYZ, and so I'm 100% sure some valuer community, somebody from valuation community must be guiding those companies at what rate you do it and other things. So there is a process of valuer being called upon for such transaction. Another very important, and I see this now as a major area of practice, is litigation or family settlements. Valuation is now the first starting point. In my good old days, once in 2 years, we will have a case of family settlement case coming to our office for helping them on valuation of the entire basket of family assets. When I say family asset, it is not physical asset, it will be in the form of various companies or businesses which they hold. Now it is once a month. The kind of families breaking up which has started happening in the recent times, last I would say 5 to 7 years, is phenomenally high as compared to what we have experienced earlier. Nothing again because new generations have started coming into the businesses. There are difference of opinions between seniors and juniors. So there is a whole lot of requirement that I want to separate, I want to be on my own. So as old traditional Indians, we used to have joint families. Now you are all having nuclear families. Why? Because everybody wants to have that freedom. So family settlement cases are coming up in huge numbers. So where valuers and chartered accountants, suppose you are guiding some group for many years, you will be the first one to be contacted. Nobody will go to a third party to do the valuation. If you are a house advisor, you will be the first point of contact. So you have to. Unfortunately, what used to happen, and first time I had mentioned this at one of the Nagpur conferences, that many of our CA friends feels that this is a rocket science, and I will not touch this subject. So most of this work gets concentrated to a larger firms, and I'm going to take up this that there is no rocket science involved. It is absolutely application of common sense. What is taught to us as a chartered accountant is more than enough for us to be in this field. Only thing is we must have courage to start and we must have courage to experiment. People feel this is a rocket science, I will not be able to handle it. There are this set of valuers, glorified people, this, that, Sujal, Shah, nothing. You can do everything. If you are a member of CHU, we are taught more than enough to be in this field. I may be cutting my own feet, but I must tell you, this is the field which has huge potential. Huge potential. I'll tell you, you may feel that there is a competition which has come in. But you know how many extra trigger points have come in? Only companies that now you have, I think, 32 trigger points where valuation is required by registered values. Then you have FEMA, you have transfer pricing, you have income tax, Rule 11 US, any SEBI, mergers, demergers. You have so many trigger points now. So whole volume has also increased. You have competition, but your volumes also increase. Enough work is there. So there is no problem. Fundraising could be another area. If somebody is going for an IPO or somebody is raising from a private equity, they first point they will ask whether I'm divesting at a right value or not. Second basket could be regulatory basket. FEMA, SEBI, income tax, Companies Act, as I mentioned. Third set of basket which is opening up absolutely very fast is intangible valuation. And why? Now you have seen transactions happening for intangibles alone. People are not interested in legal entity. People are not interested in old debtors, creditors, nothing. I just want this brand. Particularly, this happens in FMCG, pharma is the first one to go through this. That I just need Saridon. I just need Crossing brand. I'm not interested in your debtors, creditors. One cutoff date, this brand is mine. Now, for that, you will be called upon to do the intangible valuation. So, brand valuation, patents, all this. Second trigger point is all the banks are now open to lend against the intangibles as a security for which they need your valuation. Now, one again caution point, be very careful in valuing such intangibles which is used for security for loan. Tomorrow something goes wrong, you will be the first one to be called, because based on your valuation of security, see, tangible asset, so there is a land building lying somewhere. In intangible, it is in a way nothing is visible. It's only a name, goodwill, perception on which it is valued. Now suddenly, overnight, the brand valuations can change. Overnight, the brand valuation from 100 can fall to 10 because of one incident. You remember the Cadbury incident? One day some bomb was found in somewhere in God forbidden area, and how much they had to spend. They had to rope in Mr. Bachchan to revive the brand. 100 crores they must have spent to revive the brand. So brand used as a security is very risky for companies and more risky for the valuers, because you are valued using a normal parameter that it will go normally, and suddenly something happens, the value comes crashing, and suddenly there is a security which is revoked, and you will be called upon how you valued at 1,000 crores, suddenly it is now worth only 200 crores. But there is an incidence again, as I mentioned, valuation was done when everything was normal. So be very careful when you do valuation. The use of wordings in your report. Again, I'm going to cover it in the subsequent slides. How you have to be extremely careful in covering up yourself, because it has helped me. In one of the disclaimers, I had written that this is only my opinion whether to do the transaction between buyer and seller, and if buyer wants to buy this, he should carry out his own investigation, due diligence, etc. I am not responsible for any of those data which was submitted to me, and that helped me in one investigation. I was called and suddenly grilled, and I said, but my valuation was only an opinion. He was to carry out. Something was not there in that company which was claimed, and I was called as a valuer that why you did not point out that. I said, I have written that I have not done a due diligence or physical verification of assets. It was, and I have written clearly, in somebody, purchaser has to carry out his own investigation, due diligence, and verification before he wants to get into this deal. It is not my responsibility to. I have not verified whether he holds any land or something, or his title is clear or not. We go as a financial valuer, we don't get into the details. Yes, real estate valuer will go into all these details. So I'm just saying, somewhere our wordings in the report or disclaimer helps you in defending, because that's where you say that I have very clearly informed the readers that what is my responsibility, what is not my responsibility. Now it is up to him whether to take that method or take that value or not. Okay, coming back to this, another area of very fast, volume growth is financial reporting. Now auditors, I remember when I started my careers, we used to only do performance for impairment testing. Any investment you are holding, we should do our own calculation, and as an auditor, we used to take our own calls. Now all auditors wants a third party confirmation. Good for the valuers because it increases the volume, but it gives you a huge time pressure because they want to do it before finalization of audit. Data and all that jugglery is a big issue, but it is a big area of practice because every auditor wants to also keep in his file a valuer's report for any impairment testing of either intangibles or business or CGU or a particular shares which they are holding. Index reporting fair value mechanism, which has brought, was also a very boon for valuers, because every time you are valuing, fair valuing an investment for recording, there is a backup which is required. So there is a huge private equity, venture capital. So many new private equities and venture capitalists have come in. Their entire portfolio, either quarterly, half yearly, or yearly, needs to be valued. So you just imagine how many private equity players are in this country, and every quarter or every half year at least, how many valuation must be required, because each one of them are holding 25, 30 investments. Particularly those who are holding in unquoted shares will require it more. Quoted shares, everything is available. So I'm just saying the field has expanded substantially. Still, it continues to be the monopoly of ICI members. Again, I'm not trying to say that others are not capable of something, but we are very well placed with the background with which we have been taught and trained. This is absolutely something doable field. So nothing to worry that we can't do this and other things. Now, very quickly, we'll go through some of the methodologies, because it is a very specific subject. I'm not getting into the details of how this presentation will be available to you. You can later on go through it. Under the market approach, you have three methods. Again, this is not an exhaustive list, friends. This is only something very commonly being used. Market price, comparable companies multiple, which is your EBITDA multiple. You compare, you have a comparable company. Somewhere you have a comparable transaction. Suppose I am valuing a BPO, and similar set of other BPO has just transacted between two parties on an arm's length basis. You may use that as a benchmark. There are so many other market parameters, and which we will see it in the presentation, that for a hotel valuation, I can have per key valuation. In hotel, what is more important is per key. That means per room, per chargeable room. For a power company, power generation company, it is per megawatt of capacity. For a cement, per ton of capacity. For a cable operator, or for a mobile provider, service provider, it is per connection or per subscriber. So there are different market parameters which you may use. But friends, generally when you do a valuation, you use your normal methodologies. These market multiples, you do use it only as a cross check. You most of the times you don't end up using that as a main method of valuation. You use it as a cross check. So suppose I value Indian hotels, say Taj Kolaba property again, and I come out with say 2 crores rupees per key, example. And Oberoi, which is very near to that premises, there they got a valuation of 4 crores per key. I need to revise my workings. Why? Oberoi, which is just a kilometer away from Taj Kolaba, is enjoying a valuation of 4 crores per key, whereas Taj Kolaba, why it is coming out, my other methods is throwing up only 2 crores per key. Is it having an inferior average room rent, or is it having an inferior earnings parameters, or is it not furnished properly? That it will require a more expansion, capital, repairs and maintenance cost. Why? There could be a reason. But if there is no reason, you need to revisit your working and see why there is so much of difference between the two properties which are similar in nature, but uh, you can't compare it with a Taj Indore. If you are comparing Taj Kolaba, you have to find out something which is nearby. I can go up to ITC Parel, I can go to Oberoi or Trident, or maybe some other in the similar area, but I can't compare it with some, say a lower populated city, or little smaller hotels. Yeah. So I cannot have a non-comparable transaction being compared for a valuation which I have done. So under income approach, you have discounted cash flow. Under cost approach, which is now almost losing its significance, is not normal net asset value method, replacement value method, realizable value method, which is only used for liquidation of assets, or in some time you use adjusted net asset value multiple based method for any peculiar category of companies. Now, income approach, we will not go into the details. Only two things I want to concentrate on. This is the projections. how you have to concentrate, and second is the discount rate, how it is being done. Again, we'll not give, there are two different types of valuation under DCF. Either you can have free cash flow to equity shareholders, where you work out cash flow only for equity shareholders, or you can have free cash flow for all the fund providers, which is called free cash flow to firm. That means all the fund providers. So first, when I arrive at an enterprise value, I'll remove the amount which is provided by the loan providers, preference share capital, then value the equity shareholders. Whereas in the first category, your cash flow itself are only for equity shareholders. Now, this is what is the slide where I wanted to spend some time. One is, see, when you look at the projections, what is more important is how the turnover has been increased, how costs have been projected for the future years, and whether appropriate working capital and appropriate capital expenditure has been projected on. These are a couple of very important areas which you have to concentrate. Now, again, when I say valuation assignment, sometimes you spend so much time on irrelevant areas. When I say irrelevant areas, I have a company, suppose, which is earning foreign exchange and also it has expenditure in foreign exchange. Now, whether in that case dollar will be 85 rupees or 87 rupees, I should not spend too much time, because more or less similar foreign exchange is going out and similar foreign exchange is coming in. Whereas if I have a one side only export company, where foreign exchange is so critical, I should go into great amount of detail about forex projections. So you have to identify when you start the assignment which are the 5 or 6 critical areas. If I am valuing a service company like say Infosys or Wipro, my staff cost increase is the most important assumption I should look at. What is my fixed asset investment and all that is of not relevance, because the kind of size we are talking in your service company, most important cost is your staff cost. Whereas in manufacturing company, most important cost is your raw material and direct costs. So you have to concentrate on contribution margins. So you have, when you get an assignment, understand the purpose, why you are called upon, where is this going to be used, and then decide which are the 5 or 6 critical points where I need to really spend extra time. Balance will go into the routine reviews. So these are some of the important points. Capital expenditure assumption. I have seen companies' projections where they have shown 20%, 30% growth, and suddenly in the fifth year you realize you have already overshot the your capacity, installed capacity only, and without any capital expenditure. So these are very critical connected points, that when you assume a growth, you divide between volume growth and value growth, or price growth. And then when volume growth, when you look at fifth year, third year, you just examine what is your installed capacity vis-a-vis your capacity which you are projecting. Because every single capacity you will not be able to put it in the market. Generally, the trend is 85-90% is something of a total capacity you will be able to place it, because there will be some shutdowns, there will be some breakages, or you will be losing some time because of some incidents. So you have to count all of this and then see what projections are shown vis-a-vis what capex has been assumed. These are very interlinked. Second, I would say very common area where people play is the working capital. So you have 60 days of debtors. Now in the projection you will show that they have reduced it to 55 days. Now that 5 days of reduction, sometimes what it means that I am recovering my debtors faster and I am releasing better cash in the system. That means it is higher valuation. Entire mathematics goes like this. Lower the assumption of working capital number of days, higher the cash available in the system, higher will be the valuation. Now, many times to improve the valuation, you will find a projection which has shown assumptions of working capital which are very aggressive. Again, instead of rejecting it at the outright basis, you go into the details, have discussion. Another problem which I have commonly faced in our CA community is that we have this great liking of discussing only with CFOs. You have to discuss with relevant person. If I am discussing about production, I have to connect with the person who is in charge of production. If I am discussing about finance, CFO. If I am discussing about how much I will be able to push in the market, call the marketing chief. all these relevant people, we are just mostly of the times we are only discussing with CFO. CFO based on his capacity will give you answer. But if I don't have an overall picture and I don't have overall discussion, where will I understand the nuances? Sometimes in the discussion, some absolutely threatening details come out of this discussion. Your production in charge will say, I will have to go next month for 2 months shutdown. But if you see the projection, he has assumed every month there will be a production. There is no connect between the two. So unless you have the meetings or discussion on the calls and have minutes of this, tomorrow if you are challenged, you will not be able to have enough points to defend, because on this point only your regulator will kill you, saying that you have not gone into the details, what projections you have just discussed with some finance guy, and you have, so keep minutes of all these people who are relevant. There will be a huge reluctance from the client to expose you to any one of them. I'm telling you, they will not allow you to speak to MD, they will not allow you to speak to, not because of their, they want to hide, they have no time and they don't want to complicate the matter. But that is not our problem, that is their problem. If, and I'll come to the later part of the discussion, that certain things, if you are not convinced, you are not able to come to a conclusion, it is better to withdraw from such things rather than get into that mess and tomorrow repenting in front of a regulator or investigator, where you will not be able to even utter any answer. So you have to find, it may sound a little idealistic, but you will have to find that balance, fine balance between these two. We'll come to that. These are some technicalities of how discount rates, I'm sure it is something which those who have studied FM, this was taught, so I'm not getting into detail. How enterprise value. Now, another problem in most of the discussion, one side there's a discussion on equity value. Some people are talking of enterprise value. Now, enterprise value is value for the whole enterprise. From that, you remove the debt, you remove and then come to equity valuation. And enterprise value is a value for first 5 years of projections, if you have 5 year projections available, and perpetuity value thereafter. Now, issue is the first time when you call for the details, you will be asked how many years of projection you need, why you need 5 years, why you need, we'll give you only next year's budget. This kind of reluctance will first start, because more the work the other side has to do, you will see more reluctance coming from providing the data. See, in audit, he has no choice. He has to give the schedule, he has to give the grouping, he has to give the financial results. Here, he has a choice of saying not required, required. So he decides on your behalf that this is not required. Why you are getting into all this? You need only 2 years projections. Now that is a valuer's prerogative. That what is the business cycle you feel is appropriate to go through the whole set of projections. He may say 1 year only is required because he has 1 year projections ready. For him to extrapolate, it requires more efforts. So many times that is something which is not, they are open to. But if you feel that it is required for 3 years, ask for 3 years. If you feel 5 years is required, ask for 5 years.
When it comes to intangible asset valuation, for us to value future cash flow will be very difficult. And I was having a problem, what are the, if you being an valuable for intangible asset, what exactly you.
So how much is the revenue that brand will generate for you? That is the assumption.
If you want to value that product of intangibles, for example, someone explains you development software, so how you will value.
So you have to first get into the details. How much top line that software or that brand. Suppose I am valuing Lux brand. Now, how much Lux sale next 5 years I will be able to achieve, and I have to work out using relief from royalty method. So if I was not owning Lux brand, and if somebody else was owning, how much royalty I would have paid otherwise. But since here I am owning, I am saving some royalty. So it is called relief from royalty method. And present value of that is something which is a brand valuation. So your criticality will be your top line achievable from that usage of brand or intangibles. That is the assumption. It is similar to how you value a business, how you will satisfy yourself for top line.
For example, design startup, they will not have any numbers and all.
But some assumption will have to be done. So you will have to, and that is where startup valuations are extremely risky, because it at many stages it is only a brainchild of two IITians and you don't have any backup. So you have to And there are valuations which are possible. People are saying, okay, he got $1 million for 25% stake. There is no backup. In fact, at one seminar I was speaking and I found out some absolutely, maybe my bad, that method which was not so. How much is burning per year into a multiplier was a valuation which was offered. Now that is how the valuation, and there was a CA firm which has given this valuation. Now maybe I am a little old school of thought, so I could not digest those methods. But that's where you find so many startups or so many of these companies are overvalued, and it is a passing the parcel game. Somewhere that parcel will stand still, and you will find, that ultimately either public or bank or somebody will or a private equity will be saddled with that image. So coming back to your subject, ultimately you have to assume how much you will be able to generate from this brand, and if you are not convinced with that turnover, client gives you a turnover, he is not ready to change it also. You have one tool with you. Which is that tool with you? Discount rate is the tool available to you. Either withdraw from the assignment, but it's not practical, or use discount rate. You use 35% discount rate, 40% discount rate. Extra risk, higher the risk, higher the discount rate. But it's not as easy as I say. I'm just saying one option available to you is the discount rate. For any of your discomforts on the projections, use discount rate, add extra risk.
So whatever cost he has incurred to develop that intangible asset should also be considering.
But that is a cost basis. Now today his expectation will be 10 times of that.
And his upcoming clients, all of the past.
So that is again you are assuming some future income arising from that software. So it is all linked to that.
Thank you.
Anyway, these are some examples of how these methods are worked out. Easy to understand. I put it in a very simple format, starting with PBT, add interest and depreciation because I am arriving at a value for the entire firm. Remove the capex, remove the working capital, remove the taxation, arrive at a free cash flow, apply the discount rate, apply the perpetuity value. Now, how this 5709 has been worked out? Anybody can tell me? 5709 is worked out what way? Discounted the value for perpetuity. In this case, you have 3-year projections. So what you do is 435 is the last year's cash flow, free cash flow. Add 5% because I am assuming 5% growth for perpetuity. 435 plus 5% divide by 13 minus 5%. It's an arithmetic formula. Suppose you don't want to follow this, then extend your projection by 5% for another 35 years. Again, abrupt number where present value will become minuscule. You will arrive at a similar number of 570.
Can you repeat that? 435?
So 435 plus 5% divide by 13, which is the discount rate, minus the growth rate for perpetuity, 5. 13 minus 5, 8%. But many valuers don't like to use this formula, so they extend their projections using 5% growth for 35, 40 years. At some stage, your value will become very near to zero, and then you sum it up, you will get similar number 5789. It's just a arithmetical way of doing a shortcut.
Plus growth divided by discount factor minus growth.
Minus growth percentage.
So just a doubt over here, like why don't we start with EBITDA and why don't we add interest and depreciation? Is it because
you can start with EBITDA. It's arithmetic. I just wanted you to understand it better way, so I started with PBT. Otherwise, EBITDA is the starting point. You're right.
So there's no tax benefit that we are including in this or something like
that? Tax benefit on interest is nullified.
Is nullified over
there. Yeah, because we are arriving at assuming for all the fund provider what is the value.
Right.
And in your discount rate tax adjustment for cost of debt, when you work out here, there is an example I think I have given somewhere. Cost of debt on the right side, when you see, it is net of tax, post-tax cost of debt. So it gets captured there. This is just generally. So after, when you arrive at the enterprise value, loan funds, preference capital, surplus cash, contingent liabilities, all of that will get. It's all common adjustment, which is the value of investments. Now, I think good we are on this point. When I am valuing, say, Hindustan Unilever, and I have 40 investments in my books, which are into my joint venture associate companies. How do you value this? Anybody can guide me? So you will do sum of parts of such a large number of investments, 40 investments plus main Hindustan Unilever. So will you do 41 investment? Will your client have that much time? 41 to do 41 valuation itself will be like a 3 months project. So now what is the answer to that? If you have investments which are in similar line of business of the parent company, use consolidated results and apply multiplier at also consolidated level. Life may not be that easy. If it is not so, then as the gentleman said, you will have to do sum of parts, because I may have investment in chemical company, I may have investment in electronic company, I may have investment in NBFC, I may have investment in bank. I cannot do consolidated results in that case. In that case, I will have to use, suppose I am valuing Tata Sons. Tata Sons has Tata Capital also, Tata Steel also, Tata Motors also, Tata TCS also. Can I use Tata Sons consolidated EBITDA and apply a multiplier? As the gentleman said, no. In that case, I will have to do sum of parts. I will have to value those 40, 50 investments which are held by Tata Sons and arrive at a Tata Sons valuation. But suppose Hindustan Lever has invested in 40 companies which are soap, shampoo, all of this, because of some geographical reason or something, they have legal, so many legal entities. Then I use consolidated results and apply FMCG multiplier. Market approach, it is simple. You arrive at a comparable company, apply a multiplier. Market price, yes. Generally, what we as a valuer do, highest volume, whichever exchange has, we take that price. 6 months average, 3 months average, depending. Each valuation firm has its own parameters. You will find Big Four also has different parameters. Big Six also has different parameters. So each firm has, but follow that consistently. Unless you have reasons to deviate from that. Don't use this as an adjustment factor that in some cases I use 3, some cases I use 6, some cases I use only 15 days market price average. You have to have a consistency. This is pure market price. So market price also, just to clarify, we don't as a valuer take only 1 day market price. Otherwise, yesterday's crash and suddenly I take a market price, it will give a lower valuation. So we generally take 3 months or 6 months volume weighted average. This is how typically the sheet will look. Turnover of the value, total volume, and we divide it so that simplified form. This is how it will look.
So in that scenario, if the average, if the market is very volatile, person can take the opportunity of that time to make this valuation projection.
Yeah. So he may come to you at the peak of valuation. So two things. One is valuation is only valid for that period in the peak. Second is, as a valuer, I'll take a longer period. So 15 days my price, if it is increased, I am not bothered because I am taking 180 days. It may not significantly influence, and market price is also one of the methods. It is not the only method. So I am using a combination of CCM, comparable company multiple, DCF, and market price is only maybe getting 33% weight. So all this gets nullified. This is okay. Now, this we have discussed. Comparable company, you have to find out what is comparable. Otherwise, sometimes you may end up using a very different this thing. Yeah.
We go to the case study one. So,
This one?
no, the stock market.
Previous slide, एक second for previous person. That next step. Next.
Which one? You will, I think, I'm sure they will be sharing this.
I missed out.
Yeah.
Yeah. So first we decide where the volume is higher, and then which price to be considered. Either it will be NSE and BSE.
So either NSE ka 3 months average or 6 months
so
average.
Once we decide this stage, then the second.
Then
stage
is the average after that. This is how typically it will look. When you apply a multiplier to EBITDA, anything which is non-recurring or one time, please adjust this. You may have a huge profit on sale of assets, or you may have investments sold, You may have a loss on account of fire. All this needs to be adjusted because what you are applying a multiplier to a normalized profit. This again, P multiple, it could be P multiple, EBITDA multiple, book value multiple, depending on the nature of the underlying company. Now, this is what I was referring. You can have different multiples for a cement company per ton of capacity, for hospitals, number of beds, room keys for hotels, tower companies, telecom tower, number of towers, a multiplier to that. For mutual funds, AMC companies, it is generally underlying AUMs, asset under management. Power companies per megawatt, some valuation. Cable operator, I think this is what I discussed while I was explaining you. Maintainable profit we have discussed, multiple, more or less size, location. We have to see. Many times you have a comparable company, but it is of different size. So I have a exactly comparable of TCS, but TCS has 5 lakh engineers. I have 500. Should I completely disregard TCS? One option is that. But suppose you have in the universe no other comparable company, then start with TCS, apply a discount. You may use 50% discount to TCS multiple and say, because I am small in size, my margins are different, my customer base is only localized, so I am applying 50%. Example, 50% don't catch this. I am used to now. I was telling you, so suppose in one seminar I had shown this kind of multiple 12. Now this person has reproduced this slide to the arbitrator, saying that this is a presentation. In those days we used to write CA Sujal Shah, WRC, date so and so and all that. So now it is generally not mentioned. So there he says 12, the multiple is a something which is acceptable, and he was a arbitrate. I mean, helping a brother who was exiting. So something, it was giving some exorbitant value because the nature of that business was not attracting very high EBITDA multiple. But he used this knowingly, unknowingly, I don't know. Unfortunately, that CA is no more in this world, so I can't use any. But he used to come to me and he says, "You give me writing." So anyway, this is asset base, which is common. Realizable value, replacement value, fine. This is how typically asset value will look like. Most of these adjustments we have discussed. So if you have any outstanding instruments which are convertible, you generally take a diluted position. Contingent liabilities. Now, many companies you will find a huge contingent liabilities. So, say you pick up a balance sheet of Wipro, you will find some huge tax demands. So there you have to apply a probability. So many times we are not conversant with that demand. We take an opinion of a third party, either a lawyer or a professional in that relevant field. Suppose I am not into taxation, so I don't know this demand of 1,000 crore on Wipro, is it tenable, not tenable. So generally we go into that kind of opinion and keep that for our records while applying a probability of contingent liabilities. Yeah.
When we say contingent liability adjustment, if some provisions are already there, they would continue.
They are in the part of the books.
Any materializing, like from contingent to reporting as a provision, then in that.
So one is for Ind AS has different requirement of accounting purpose, certain things only require. But as a valuer, you are giving a fair valuation. Now suppose when the transaction will take place, the contingent liabilities will travel with the new buyer. So you need to take cognizance of that. You may apply probability of 10%, 20%, 0%. Depend on underlying demand. Nowadays, sometimes you have very huge GST demands. Now, many of them have not been recognized in the books. But what people say that even to defend this 500 crore demand, I will have to spend at least 10-15 crores. So apply 5% probability, like that. This is some very, very broad knowledge-based companies. Generally, you use income-based or market price combination. Manufacturing company, you may also want to add asset valuation as one of them. Brand-driven companies, limited life projects. These are road projects, highway projects. You have only 10-year visibility because your project ends at 10 years. After 10 years, you have to hand it over back to government. In that case, your projections are only for 10 years. So you may use only income method. Investment companies or companies going for liquidation, asset base. This we have discussed already. So weightages. So sometimes there is a confusion how these weightages are applied. So weightages are you may apply different weightages to different methods of different companies. Only thing you must have a logic that many times people follow. In good old days, we used to follow Hindustan Lever Tomco judgments, where 20% was asset-based valuation, 40% was earnings-based valuation, and 40% was market price. So 1 to 2 was the weight given by Hindustan Lever Tomco case, which went up to Supreme Court. So for many years we used to follow that, but then we realized that we can't consistently follow it because underlying reasons, somewhere market price is not relevant. So I may give zero weightage to market. Unquoted companies, there is no market price. I may load that weightage to the earnings based method or CCM method. Some very fast we'll cover some issues in the valuation. Most of this we have covered. Only challenge which comes is if you are valuing an international company. Do you get enough data? How do you handle such international valuation? Because you are valuing an Indian company which is holding a share of a subsidiary, which is a foreign company, which is not into the same area of activity. Then you will have to do sum of parts. You will have to find out multiples enjoyed by that company. So you will have to do a lot of research. Luckily, lots of this data is available now on the internet. If not, you have lots of software is available. Now, there is a suggestion which we have also given to RBO that whether we can have at each center a database which is purchased and available to our members as a part of maybe some small fees. Say, I want to use it for 1 hour, I can give 500 rupees charge and use that. Because many professional brothers or sisters may not be able to afford that 1 lakh rupee or 5 lakh rupee investment only because their volume of valuation practice could be very low. This is not only used for valuation practice, many times it is used for transfer pricing reports and everything. So many people have invested into such packages. Some people want to maybe use the services. So there is a suggestion. Let's see how it goes. I think most of the issues. Before we go into other aspects of valuation, I slightly exceeded the time, but there are some judicial pronouncements. If you want to be in this field, these are the cases which are Bible for you. Must read cases. So first one is exchange ratio is not disturbed by courts. Courts have said all along, courts have taken a view that we are like umpires in the cricket game. We will just make sure that you play as per rules, but we will not teach you how to play. Means courts will never tell you you should not have used market price method or you should not have used CCM or you should have used this multiple. Either courts have appointed a third valuer or second value, or they have said as long as it is maintained, you have followed the rules, I don't want to disturb the ratio. So Mir Mafatlal Industries and Dinesh Lakhani versus Park Davis, these are two good judgments where it's a speaking orders where you can read how it will give you a perception of how courts look at the valuation. There is one English judgment also, which, because many times when we are faced with some regulatory investigation, they go into, if I use 12 and half multiple, they want to have arithmetical accuracy of that. Show me where 12.5 you have, what is the backup of that? Now, many times there is a subjectiveness of that also. I may have come with 12.3 and I have rounded up to 12.5. So this judgment, many times it helps us that it says mathematical certainty is not demanded, nor it is possible. So valuation is not a field where, it's like a pure science where you just apply a mathematical formula. Otherwise, I remember good old days, there was a person who had developed a software for valuation. That you just put these asset liabilities and PNL and some other click of a button, you will get the valuation. You just write some industry, but it never saw the light of the day because that is something which is not possible. You can't have a software driven valuation for a regulatory approvals. Hindustan Lever and Tomco judgment, which is the last one, I mean, on this slide, it is fair to use combination. There the challenge was that valuer has used 3 methods and given different weightages. And very celebrated case, very detailed Supreme Court judgment. You must read it. I've given the citations also. Cadbury is another case which was a recent time case where I think the whole thing is that it is not possible for a court to go into the exercise of carrying out a valuation itself. Courts do not have the expertise, the time and the means to do this. I do not believe, the judge has said, I do not believe that they are expected to do it. What the court's approach must be to examine whether or not a valuation report is demonstrated to be so unjust so unreasonable and so unfair that it could result into manifest and demonstrable inequity or injustice. This injustice must be shown to apply to a class. No valuation is to be disregarded merely because it has used one or the other various methods. It must be shown that the chosen method of valuation is such as has resulted in artificially depressed or contrived valuation well below what a fair-minded person may consider reasonable. Again, Cadbury judgment, it's a Bombay High Court judgment, you must read it. It has a very detailed discussion on valuation. Now comes the section B. We have about 45 minutes. I was told if you finish early, no problem, but I'm sorry, I will go up to 1 o'clock. Only 4 slides, but it may take a little more time. So, the WRC wanted me to also cover how you went into this field and how you. So, one thing is that I qualified in the year 1991. I was fortunate that I passed in the year where India opened up its economy. I was fortunate that I was in a firm which had courageously started as one of the area of practice of valuation that time or prior to that, much prior to that. And I must say I got the benefit of guidance of some great mentors or gurus who taught me this subject. But prior to that, I must tell you, first of all, out of 120 chartered accountants employed in the firm, how I came into this field. And nobody can guess this. Only because I was holding a passport, I am into valuation field today. So when I qualified, that time young, the thing I said, let me just take out my passport first. So I had a passport ready. I was working in a firm, 120 odd chartered accountants. Our core area of firm was audit practice. I was in some audit, somewhere doing some audit and hardly visiting office. One day I get a call from my office that, Sujal, do you hold a passport? I said, yes, I'm holding a passport. Tomorrow 9 o'clock, come and meet the boss. So 9 o'clock, I was in the office with the passport. And that time we had a client who was acquiring some tea estate in Sri Lanka. And 4 chartered accountants had to be sent there for work called due diligence. So sometime in early 90s, the first time I heard this word called from my boss, due diligence. I was a hardcore into audit. And I must tell you, whatever today I am, audit background has helped me a lot. Today, I get youngsters for articleship who tells me we are not interested in audit. I feel like crying. That audit is the field where you learn how to read a financial. So audit is a highly respected area, and I must tell you, it really gives you a chance to read a balance sheet. Because you will prepare a balance, you will be party to the whole financial statements. So then nobody can beat you in reading a financials. So first time my boss told me that we have a client who is acquiring tea estates in Sri Lanka. You have to go for a due diligence. So I had to ask modestly, sir, what do you mean by due diligence? Early 90s. That time this word was not very commonly used. And he explained me and he says, don't worry, you do this, 17 tea estates we had to go. So we are put into different teams and 4 of us went to Sri Lanka. And unfortunately, there was some bomb blast there and we had to be airlifted back to India. And again, we went back and my boss came 2, 3 times and saw the work. Cut two. One assignment done, second assignment, something similar on valuation came. We are doing that time lots of merger valuation for Unilever Group, Brook Bond, Lipton, merging with Hindustan Lever and all that. So all those valuations were jointly, one of the valuers was our firm. So when such work used to come, he used to lift me from the audit and I used to be helping him on those assignments. And I really remember because it was many times it was affecting the audit schedule because you are working on an audit and suddenly you are out for 10 days, 15 days. Uh, so come second half of 90s, he announced that now he'll exclusively work on valuations with me. And that's how I came into this field. And so first 2 points is that I was at the right time at the right place. So India opened up the economy. I qualified that time, and I was working in a firm which was into this, and I had extremely. I'm indebted to that that group of partners who taught me this today also. Without them, I don't think so I could have reached this place. My first speaking assignment, I replaced him as a speaker in some study circle, and that memento, is today also lying just behind my table, because that is something which also gave me the confidence to speak at a public forum. And he had accepted and he had to travel. And he said, "Okay, Sujal, go. Somebody will, tell you what is to be covered." And I got some 2 days to prepare. Some Friday night, he told me Saturday morning, Sunday morning, you have to appear at some of these kind of conferences, and it went off like that. So I had to, of course, once I went into this field, I had to also make a lot of efforts to learn this subject. It is not that it was just because you are in the field and you are chosen to work. Maybe if that time I had not matched his expectation, out of 120, somebody else would have come. But I was luckily in that field. Luckily, I could work, understand, learn, so I could at least able to sort of meet his expectation, and that's how learning takes place. What has helped me a lot, and many times my fellow friends, CA friends, used to tell me, why you are going on Sunday to some god forbidden place like Jharkhand and speaking on valuation and all that. Every time I go to speak, I still have goosebumps before I get up from my chair, and because I prepare for every meeting separately, that helps me to upgrade myself to different levels. So speaking, somebody may say it is a sacrifice, but I must say it is an investment. It has given me such a great exposure to discuss with people different mind frame. You should be open to receiving questions and understand how a person, he asks some questions, so I have to understand what is his doubt and then answer. So great, I'm telling you, that is I must have got larger than life, recognition is because of speaking assignments. And I have gone across the country to sort of I'm not again trying to say that I've done this on my own, but to popularize this subject. First time I spoke on this subject at a place called Nagpur, people are saying valuation, we'll give it to Bombay firm. Why we should do this valuation? So there was a new chairman, he had kept this 2 hour session on valuation. First time, and that person today, the chairman, is today doing maximum number of valuation in Nagpur. And he keeps on telling me that first time when you spoke and I had invited you, he was the chairman of the branch that time. He says, thereafter our firms went into this field. So one thing is that we are not helping anybody, we are helping ourselves when we go to speak. A lot of sacrifice required because most of these sessions are on weekends. So, but I must say that is major contributor. When I was preparing my notes, that what has helped me to reach to this some kind of even whatever modest recognition is, one of that is CA Institute has played a very important role, because, and luckily most other valuers refused to go and speak at any conferences or seminars because it was on weekends. All these valuation courses are generally on weekends. So you have to ultimately, I have taken 4 o'clock flight for Delhi and reached the Noida office over at 9 o'clock and started a session, continuously standing on my feet till 5 o'clock. So when I used to sit in the aircraft for my return flight, my legs used to shake. That kind of, because you are continuously standing and speaking and you are traveling so much. But it used to give that satisfaction that you are returning back to something what you have got from this institute. Again, it may sound idealistic, but I must confess that is the one of the major factors. Now, after that also, it is okay, you got recognition, you are in this field, continuous learning. As I mentioned, unless you keep on learning, average, I was just working out while preparing this, how much average learning time I am giving now. It turned out that in a month, if I do average, some days it is 0, some days it is 4 hours, some days it is 2 hours. It will be anywhere between 1.5 to 2 hours a day. Learning, when I say learning a new instrument, how to value a complex financial instrument. For me, it was a very new thing. Where we had heard of this optionally convertible, redeemable, this, that, preference shares. This is I never heard when we qualified. Suddenly you have to start thinking how this, then you have coupon, you have zero coupon, you have some premium payable at the redemption, all these complexities start getting added. So this learning, and I must tell you, it is you don't learn from your seniors. Many times you learn from your colleagues because they are very fast. They have learned something in their CFA exam. They will teach you. Keep your eyes and ears open. Learning will come from any source. A simple peon also sometimes teaches you a lesson. So once you keep on learning, there is no looking back. So I was very fortunate that at ICAI, when we first time rolled out the valuation course, I had designed that course for the CH. That time it was valuation certificate course on valuation. So that and once I designed, I remember the president also, Mr. Kamlesh Bhai Vikamsi, he told me, now you have decided you have to go and teach everybody because we have no very less speaker and I used to that time call my friends who are in valuation practice. Arey, Sunday, can you go to Delhi? This Saturday there is a session at Coimbatore. Can you go? People used to just refuse. No, no, no. Weekend mein kaun jayega? So many times I had to actually okay, nobody is available. I'll go because there was an obligation that you have to finish that course. So it again gave you a huge. So second is drafting valuation standards, as I mentioned, huge. And third now at the RVO level RVOs, various committees. I'm also part of the journal. I'm a chairman of the journal committee of RVO. So all the journal which RVO comes out with, all the articles when you read, you design sometimes. So it really helps. It really helps you to increase the horizon of learning. Another thing which I have one specialist called Sagar Bhai in my office who helps with me to prepare answer for all the queries which across the country I receive queries from valuation on the valuation field from my fellow chartered accountants because most of your emails are available. So people send query, and I have a person who helps me in first. First, he will draft, then he will show it to me whether this answer is right or not. We will modify it and we'll send the answer. Sometimes we'll speak to that person that what you have understood is wrong. You should do it that way. Now again, you feel it's a waste of time. It is helping you to learn that subject because some question which has come from a very small area in Calcutta, you will never feel that such question may come up. Many times they have learned something in the course and they have misunderstood certain things what was taught. So they will write a question, they will call up. Many times I have WhatsApp questions coming up that this is what should I do. So all this is again a process which and of course you should never look back from hard work. There is no alternate to hard work. You once you feel that you are now reached a place and complacency goes into your system, absolutely your downfall will start in profession. Yes.
I want to understand like, how to capture the assignment. Like, basically,
Slides are
before
coming
the
up.
plus somewhere my normal point is we know the knowledge is there, everything confidence, even confidence is there, but client is not developing confidence on startup CAs. This is my question.
So I'll tell you. So same. As a only difference, I was part of a firm which was having some background or some history of carrying out valuation. And secondly, it comes over a period of time. The problem in the current generation, what I'm seeing, there is no patience. So when I started in early 90s, I am reaping the fruits in 25. After how many years? Is it, do you think it has come overnight? No, it comes with a process. It is a process. Problem is that we lose hopes halfway.
I can say I was working in a bank wherein every month the salary was getting credited. After 1 year, I started my CA practice. Now I am answerable to my family.
Correct.
I am answerable to my mentors. Then they will ask, what are you earning? What is your opportunity cost? And then I will have no answer. Then if you say about patience, it is not about losing the patience. It is about getting a guidance from an experience. If you have seen 25 degrees more than us, so you should every the one who are elder to us should guide us because we don't have our grandparents who are sick now we have
Absolutely.
brother and sister who are sick so somewhere on we are in the midway and then I think
In
many
the
of
market price question, what did I answer to him? One day market price is not relevant. So 1 year income is not relevant. You look at a total period of
people
one
talk about
decade.
opportunity cost.
So opportunity cost because you feel that what you are today doing is not adding to your knowledge or adding to your experience.
Confident of myself.
You don't have to prove to anybody other than yourself.
There are noise pollution.
Outside, so that noise you have to just put your earplugs. Nowadays, youngsters sometimes on the road they are walking and talking. I said, whom they are talking? Then I realized they are talking on some. So I had to come out with a circular in my office that nobody on the road will speak because there were accidents. You know, people are talking on the road. So you have to justify yourself.
Parents, they're not parents, they are the own. You know, you're talking about earbuds.
So,
We took my one earbuds now.
yeah. So no, that was on the lighter mode. But I'm saying it
Earbuds
is.
is taken from my mom.
Yeah,
My
yeah.
mom has एक ही earbuds, एक कान से सिर्फ सुनने का है मेरे पास.
I know. So no, I can understand and absolutely relate to what you are saying because I was asked similar question at a conference I was speaking at Delhi. Somebody from the bench said that all this what you are saying is an idealistic situation. But today my client comes and tells me that I need a valuation and I need it for 10,000 rupees. What do I do? I said, if your cost is not there, you are the only person. He says, I am the only person in the office. I have no employee, nothing. I said, then whatever you earn is reducing your fixed cost burden. Secondly, I told him that once you have taken up this at 10,000 rupees, forget what you are getting, give your best. See, I'll tell you, you feel that clients are not observing you. And I was actually, we have slightly overshot in terms of this was there coming up in the next slide. Who are your clients? Your clients, they are observing you. They may observe you for 3 years. And fourth year, you will have a major work coming up from there. Because they are extremely smart than what you think. You think promoters are not watching you? Promoters may watch you for 5 years that wow, this person in the toughest time, how you react in the most lucrative opportunity, how you withhold from yourself from such lucrative opportunity coming from that company, and you have stood with your principal. They will observe. Fifth year, you will get a lottery, but that patience is required. The best thing is in the current generation, I keep saying, keep your needs very limited. So you are not compelled to do anything which you don't like. Problem in the current, when I interview people, they have such high aspirations that I have so many items to be boxes to be ticked. I have to go to Europe next year. I have to do this. So once you have such aspiration, not bad to have aspiration, but you can't then, if you are not able to match, you can't just put that as a compelling reason to change.
There is saying in Gujarati, "Pagatlas Paravan Chadar Huye."
So you have to understand that also. And I'll do, some people say that we don't want to go in practice. I'll tell you, practice is the best area. You are first of all, you are king of your own thing. You don't answerable. 5 बजे निकलना है, हाथ निकाल के निकल जाओ, किसी का पंच नहीं करना है अपने को. But the fruits in the practice comes only in the fag end. In the, I mean, the last couple of years of your practice, you will get the entire fruits of your entire 20 years of experience, and your mehnat with the client will give you benefit in another 20 years. Second half is the movie of where you will get the fruits. First half will be only mehnat. Anyway, idealistic, but I'll tell you whatever I have understood. Now, how to develop the requisite skill set. So again, this has to be bold and underlined that what we are today, given our opportunity by the CA Institute, is more than enough for us to be in this field. We don't have to worry that knowledge is not there. Knowledge is there, starting point is there. Only you have to add on from there. Then second is now added requirement, ICA registered valuer also is required, because you can't say that I will not give registered valuer exam. Because my vision says next 2 years, every regulation will change to registered value. Then you will not be able to do any valuation if you are not. So start this first, your exam, registered valuer. Third is read relevant articles in financial newspaper and magazines. So many times when we pick up economic times, if I am in audit practice, I used to even not look at what transaction, kitna mein kya shares, kitna BPO, kitne mein becha. I should not even give those. But when I went into this field, I realized that all those relevant articles or anything which is business magazines, what is geopolitically happening, your whole reading material also changes according. And I'll tell you my regret also. Sometimes in that reading those things, I have actually forgotten my touch with my core, which is audit and tax. If somebody says that you don't need to learn audit and tax for doing valuation, you are in a absolute, wrong perception. Audit and taxation are the roots of your valuation work. That will give you a starting point. आजकल new articles, if you interview people, they're saying I don't want to do audit, I don't want to do tax, I want to do valuation. I said, what will you do in valuation? I give him a balance sheet, read this balance sheet. They don't even know where the borrowings are written. I said that starting point will come once you do audit. So articles you do in audit or taxation, your base will improve. So read relevant articles in it. Only thing, one point I must say, that don't blindly rely an article given by a financial daily or magazine. Sometimes the way it is reported. And I'll give you a simple example. A company had 100 crore EBITDA. The deal happened at 1,000 crores. What was reported? Company got 10 times EBITDA multiple. Since I was involved in the assignment, I knew that company got only 8 multiple. So 100 into 8, 800. 200 was given for one of the vacant lands which was there in the company. What was reported in the next day newspaper? Company got 10 times EBITDA multiple. Now that should not become your benchmark because you are not knowing the facts. So mostly you should read stock exchange announcements. They are most authentic announcements. Newspaper articles are good starting point, but don't blindly rely on newspaper articles. Attend relevant seminars and conferences. Many of these conferences are there now. CA Institute, ICSI, sometimes Ashwath Damodaran, who is considered to be guru in valuation, visits India and is UL seminar, of course, charging 50,000, 1 lakh per 2 days or 3 days. But suppose you want to make a life in that particular field, you may attend. So, relevant seminars and conferences. Be a part of network or a study group. Now, I think WRC had a study group on valuation. I don't know whether they've continued there. Now, if you're part of that study group, unfortunately, I was asked, but somehow I had limited time, so I could not be a part of it. But that study said, what, you will have all like-minded people. You will understand the problems faced by valuer community. Where is the problem lying? How can you solve it? That study circle will not only teach you technical aspect of it. While having a tea down, you will be able to discuss a lot of other things. So your network will become very strong. Today, if I have any problem, I can pick up a phone and talk to Deloitte partner, EY partner, anybody in the country, because that relationship has built over a period of time. We can very well speak to anybody about a doubt about any adjustment which I am thinking, is this the right adjustment I am doing? If I have a doubt, that problem is not, because that network is created over the years. Membership of professional association, many times there are specific associations, like say in our case Bombay Chartered Accountants Society, Chamber of Tax Consultants. You have very specific organizations which are also part imparting a lot of knowledge. Becoming a member of such association not only technically uplifts you but also creates your network of amongst professions. Then some small conferences you can start speaking. So a small study group meeting you can start speaking. Once you start speaking, you can go to higher level. It will not start with the regional conference of WRC. You start to speak on valuation to start with. That comes after 20 years of experience. Then you will be invited. But at least you can start with a study circle, then upgrade to that. So you keep uh, being with relevant people. Keep constant watch on regulatory changes. We are now still into a field which is still evolving. It is not an established field. So continuous some changes will keep on going. So all relevant websites you keep on watching. Some change will come in IBBI regulation. RBO may make some changes. Now we have a peer review of valuers. Are you aware that there is a peer review mechanism for valuers? So so now we have our valuation files are open for peer review. Even SEBI had that power, that any merger valuation, if I give SEBI had the power to walk into your office and go through the workings. So that's where your file has to be absolutely up to date. Internal, if you have a team of people, internal brainstorming training sessions are very important, because that is where even the absolutely fresher also you will give chance to speak. You will find out, so there you are building up a team which is brainstorming continuously on a subject, and that's where you will keep upgrading the entire team. And better in trained team will definitely improve your result because ultimately it will benefit the entire organization. Give highest importance to quality of work and documentation. I think we have discussed this enough, so I will not elaborate in this. Documentation will have to be absolutely above par. Now, don't succumb to outside pressure is the point which, when I was drafting, whether I was thinking whether to write or not. What is outside pressure? Your client is your outside pressure. I got sometimes request on Friday evenings for a Monday morning board meeting valuation requirement. I said, you come early, you should have come on Sunday night. That kind of short time people are offering to do valuation. Now, what to do in such situation? You have to assess your capabilities, you have to assess your team. Will you be able to do 2 days? I'm giving extreme example. People give 7 days. Now, can I do 7 days valuation of say Hindustan Unilever? If if you're geared, you have a team, you can do it. If data is available. But suppose you are only two of you and one of them is going on leave, then 7 days you can't do it. So those pressures, many times our CA friends, what they do, they accept the work. Then they don't realize that my deliverable is coming up and I'm not prepared. Then compromise on the quality. Second pressure which comes from outside is on the fees. Now there is a fashion which is now there where you quote 100 people will say 50. It is like a subji market. This is how when I started my practice and I was at a firm, we had no engagement. After the assignment was over, my boss used to just call up that time CFO was the word was also not there. So the president finance he will call, okay, we have done this, our fees will be so and so. Okay, please send your bill. Nobody used to even get into this EL, advance, nothing. Now everybody, the CFO wants to, on some cookie point, so he will say, हाँ, boss को जाके बोलेगा, valuer ने 100 बोला, मैंने 70 में close किया. Now because it is not that we are worth 70, it is because he wants to show. So, and ultimately, CA friends also, they want to get the work, so they will also succumb to this pressure. Now, many times it is not possible for you to do it at that cost because your cost of people itself will overshoot that requirement. So, at some stage, both on time and free pressure, you have to either give up or say remain firm. In most cases of time pressures where I have refused that I can't do this in 1 week, they increase the time. In most cases, I'm not saying in all. I have lost assignments also because of that, but it is fine. And in most cases of fees, you set your bottom that I can't go below 90 rupees.
There should be standard benchmark to all.
There is no benchmark, unfortunately, in this field.
One professional, this bargaining is just because of the professional colleagues are doing.
But see, your cost is different sitting in Mumbai. Suppose he is sitting in Mofussil area of Nasik. His cost is very different. He will do same valuation for 10,000. See, now valuation you can do from anywhere in the country. You need a registered valuer license. So what I'm saying now, you are not competing with same city. Your point is right that within same city you can compete. You can have a consensus, but he will say my cost itself is low. Recently, I saw a registered valuation report where a Nasik professional had issued. I asked him, what is the fee you have paid? 15,000 rupees he has paid. In Mumbai, nobody will touch for that, but he has done a report. And they said, yeah, he has agreed happily for doing it for 50,000 because his cost also will be low. But now there is no boundary of Mumbai and Nasik. People can do anywhere, any valuation. So I'm saying you are not competing with a Bombay chartered accountant. You are competing with the whole country. And you are not only competing with chartered accountants, you are competing with other professions. Now a company secretary who has a set secretarial audit practice, this is one added area. He can do it for free also. 5,000 mein karte. Now why? Because he has a set income. He is fine to do it at 5,000. It is reducing his fixed cost. He is fine with that. Now that is his choice. That's where you have to make your answer. You can't blame others. At some stage you will have to give up the assignment or you will have to stand firm that I can't do this. So this is the outside pressure of time and fees. They are extremely high for a smaller firms. This is the biggest challenge points.
From your experience, is there any time where besides these financial issues, any overpaying the again expectation to give a higher valuation?
Number of times. Number of times you are called and said, we have agreed this between promoters. Now you have to, so in some cases, it fits into the elasticity range, you can do it. Otherwise, you can't do that. In many cases, they too have clinched the deal at 100 crores. Now you are told, हमको तो regulator के लिए I need a report of 100. Now you may not be able to give at 100 because underlying value itself was, something different. So that is where you will have to draw a line how much I can give. So one is professionally, I'm not at all suggesting you should get into that area. If you're not convinced, you sign only what you are convinced with because you assume every valuation report. If today I have to sign, I have to assume that there will be an investigation.
So the thing is that this is real business world. The promoters are the kind of person, so they don't come to it in the beginning.
They
don't come to the beginning about their expectations like that. It's all the hidden or their own. So there can be a hostility at a later stage where the regular has to.
no, but that you address it while accepting the assignment.
Yes.
That I will have my own parameters and standards. I may not match with whatever you have agreed upon. Only with acceptable, please take my engagement letter. Otherwise, you clarify. I have written that point in the next slide. That in your engagement letter, terms has to be very clear. That this is not dependent on some conclusion which I am confirming.
So nowadays, lot of startups, this is what they are getting into. They come to us or they come to a register valuer and they say this is the valuation that we need. Rather than, a valuer first assessing everything and then coming up with a valuation. They say we want a valuation of 10 CR, 15 CR because we want to raise funds. And there are a lot of valuers who are doing it. I mean, they justify it in the reports and they are doing it.
That's what she was saying. Then they build the projections like that.
Correct.
And in some cases, our own brothers and sisters are preparing projections also. तो startup के पास तो कोई है ही नहीं. Startup वाले बोले you only prepare projections and you only prepare values. Now there is a straight conflict first of all. And you are absolutely right. These are challenging areas, and there are professional brothers and sisters who are accepting such thing and signing, but extremely careful. We have to be very careful.
Well, I have seen cases where, let's say, a company has a very less turnover, but they'll say, oh no, we are growing at 100%, our growth rate is 100%, and right now they are making losses. But still they get the reports, and then later on when I see the report, they have a valuation report, and which is justifying the valuation. I'm like,
I have had projections which has still in the last year of projection, 10th year of projection also, they are still in losses and still they have got valuation, which are hundreds of crores. So it is not linked to, that's why I'm saying they have some weird method of total number of amount you are burning into multiplier, total number of employees into multiplier, total number of hits into a multiplier, some different methods. But the proof of the pudding is that any valuation you do, ultimately that company has to start making cash flows. Unless there are positive cash flows, you will not be able to have valuation.
But sir, what role the institute is playing in that? Because this is happening at a very large scale right now. Because there are so many startups, and the founders know they are not aware about the legal things or let's say how the valuation works. But the founders have expectations that no, मुझे चाहिए, मुझे इतना करा के दे दो.
But there are I have seen registered valuer also issuing such reports. See, they will have some logic of projections. They will ultimately use some parameters, some multipliers, some justification. But that's why I'm saying. I was telling that gentleman that every time you have to issue a report, you assume this is going to be investigated, and then your entire preparation will be like that. Your paperwork will be, designed to do that. It may sound like a conservative thinking, but the more you are prepared for defending for possible future investigation, your quality itself will improve.
What is the magic in the valuation for the loss making companies also get the funding in that?
So there is another method. People are applying now top line multiple. So there are loss making companies and top line multiples are there. 2 times multiple to the top line.
So in that case also we are responsible that funders say promoter.
No, we are not responsible for companies not performing as per projections. As long as you have written that this is by and large we have reviewed the projections and for its reasonableness. But real life they may not achieve that. That is not something our responsibility. But the problem is that, as the gentleman was saying, sometimes some weird Valuations are thrown in the market, and then suppose just take an example. In such cases, one of the banks have invested. Tomorrow you'll have CBI at your door if something goes wrong. Because they have to investigate every case where there is a possible fraud. So just imagine the kind of seriousness people have. Don't know the 10,000 ka 50,000 ka report mein what it brings to your doorstep.
Then so sir, it is more better that we do valuation because when we do tax audits or tax audits, we are more responsible in that because there is no such assumptions that we can do what we can do in valuations.
So both have their own inherent risk, but as long as you have logic of something what you have done, I don't think so one has to be frightened of it.
What is the liability of the person, the registered valuer, with the CBI or any regulator comes to their door?
If there is criminality, there is no criminal charge, there is no limit. But if it comes to a civil thing, generally in the engagement letter you write that your maximum liability will not exceed your fees.
And if we have a registered value entity, in that case, the entire entity would be liable, or the person is.
So as of now, they are picking up only the person who has signed.
And can we have a limited liability company for this?
Yeah.
And is the CA practice and the RV practice can be different entities?
But you cannot have common partners. So most of the, suppose I don't want to name the firm, but you have a CA practice, you have a valuation LLP, XYZ CS, XYZ valuation LLP. You don't have common partners because that LLP registration will not be granted if you have audit partners also there. Or LLP valuation firm entity registration is possible only if all the partners are also registered valuers.
And at the same time, they can have a CA firm as well. Right?
Same people cannot be a part of other practice areas. Now IBBI or RBO will not register that entity if you have any cross connection with any other legal entity.
One of the partner can be a partner of other firm?
I don't think so. Because there will be, if there is a connection, they will immediately question that. But real practical issue, how call, unless you have to give some undertaking in there allowing CAM only as a partner because of the ownership issue or something, I'm not very sure. But generally, my recollection of all the rejection cases which comes for discussion is that because there was a common partner, they refused.
Even one common partner.
But CFO is not not signing the audit of it. They can take the valuation assignment as a registered entity.
Provided all the partners are registered valuer and you have registered your CA firm as a registered valuer entity. Today in India, you have extremely low rate of CA firms being registered as a registered valuer entity.
Because it's not being allowed or
no, people want to also be in other practice areas. So they don't register the CA practice. They register in that separate LLP what he was referring.
In the case of the issue of preference shares or something like that, you need the RV to be certified the valuations to get it the NAV. So in that the assets and machineries are not being revalued because that is not in the scope of the financial RVOs to get the revaluation. So they mentioned that at a cost. Is it right?
No, if you have to value those assets, then you appoint registered valuer who is practicing in that area and rely on his report and mention in your report that I have used ABC's report for land valuation. Or
I have seen the reports of the valuers.
Yeah, it cost.
They mentioned at the cost and they have disclaimed that it's not possible for us to.
I don't think so. That's correct because you suppose you are giving a valuation for a resolution case. Those value also will have a different. Today, iron prices itself has changed. Yeah. So you have to get the valuation of those. Now, where do you get this work? Sorry, we'll just finish this so that otherwise somebody wants to leave at one, at least they will miss the slide. So where do you get this work from? So one is existing or past clients. Of course, you have to check for conflict or independence issues, which because suppose you are having audit client, you can't do valuations. But suppose you have class advisory client and he wants to do valuation, he will come to you. Secondly, there are CA firms who are not into this area of practice also may approach you for valuation work. If you are into valuation, because many of them, they don't want to start the valuation practice. So that is one source of work. Third is these auditors, as I mentioned. Many times auditors want this third party confirmation, so they will ask the company to get it valued. And that's why most of the companies will ask whom you are comfortable with. So they will refer 4 5 names. You could be one of them. Other professionals, many times cost accountants, CS, lawyers, they also have need for values. Lawyers are the first starting point for most of the foreign joint ventures and all that. So work originates from lawyers' office also. Investment bankers, if they are in the middle of a deal, they will engage a valuer for valuation of the company. Wealth advisors, all these most of these banks who are managing wealth for high net worth individual, if for doing any transaction, many times they refer walk to the valuers. Family offices, executives or consultants are one of the other areas where. Sorry. Why this has become So NCLT, you can also be appointed through NCLT or NCLET or any court. Many of these litigation cases, sometimes the court they have registered set of valuers, so there also it can originate. Arbitrators, mediators are another area of very commonly. How fees are charged by valuers? So generally, if I am a practicing chartered accountant, I can't link the fees to the value of the assignment. I am debarred by my law, I mean my the rules and code of conduct. It cannot be linked to the. So I can't say that if I succeed, I'll charge you so and so, or if I from your 5,000 crore, I will charge you 0.5% or like that. It is generally and mostly based on either estimated times of each level of people whom you will engage in that assignment, or many times it is lump sum because you are not able to estimate. You take a chance, okay, I'll charge you 2 lakhs, 5 lakhs, whatever. Then sometimes it is a loss also, sometimes it is a success also in terms of because many times clients are not very comfortable with the time based. That many times you say, okay, for partner I'll charge 100 rupees, for senior I'll charge you 80 rupees, for junior I'll charge you 50 rupees, article clerk I'll charge you 20 rupees. That people are not wanting to nowadays deal with any open ended time commit value fees commitment. So they will say you tell us lump sum, you calculate and tell us. So then you estimate and do a lump sum fee calculation. Success based fees non-chartered accountants can charge. Many of our chartered accountant firms friends who have gone into merchant banking license or only advisor, they link it to person because they are not holding COP. They are not bound by strictly by our code of conduct.
But if that's never calculated to something like that, if your valuation is about 20 crore, you will charge this much.
If you are not practicing chartered account, put any condition, it's fine. Practicing chartered accountants, you cannot link it to the
There's no percentage.
Generally, people are not linking it to any result of the valuation. There are some past disciplinary cases where institute has taken an extremely strict view. So don't take that chance. It is very common nowadays to charge based on the stage wise, and I'll tell you very jokingly one. It happens that many times people will suppose you had a lump sum fee on issuance of report 100%. Many times the draft workings are taken from you and they never take a final report. Only income tax में आएगा तभी final report के लिए आएगा. So nowadays that's why valuers have also become little smart on signing of the engagement letter X, on issue of the draft report so, and finally on final report or within 15 days of issuing the draft report, whichever is early. Because otherwise he will say okay final report लगना है तो last के 20% बच जाएगी. But generally now so many valuers used to lose the fees because the last 20 or 25% never used to come. Because if it is for internal transfers and all that, they will never take a final report. They will take a draft report. So generally nowadays this new added clause is that within 15 days of issuing draft report or on the issue of final report, whichever is early. Now, terms has to be very clear in the engagement letter, sir. Here, that we have to be extremely clear that we will not be bound by this. We will not go by this. Quality of work cannot be linked to the fees charged. I cannot say मैं 10,000 charge किया तो मैं इतना ही quality. Having accepted at 10,000, you have to still maintain the entire quality as if you are getting 1 lakh. Possible many cases of litigation related valuation, you have to inbuilt valuation for any possible litigation against you. We are the easiest target. We are sitting ducks. We can be targeted by any brother. If you are helping two brothers to resolve their problem and issued a report, they can go to. I have a case. Somebody went to High Court against my report because he had some problem with his brother, and I had to engage a lawyer and defend myself. And client never wanted to pay me for that. So in your engagement letter, be very clear that if there is any litigation and all that, it will be on their account, that we will engage a reasonably good lawyer in this area. Fees for arbitration. Many times in arbitration, you are called upon as expert witness. Now those arbitration meetings can go for months. In the sense, 3 days now. After 5 months, another 3 days. Arbitrators, whenever they have time, they will call for hearing. You are cross-examined. Now you never have clarity. Again, after 5 months, when you are going for a hearing, you have to prepare yourself as if you are doing for the first time, because 5 months mein to so many water would have flown. So you have to again. So all these costs generally is added. If you appear as an arbitration witness, be very careful. Your fees have to be either linked to the number of hours or number of appearances. And lastly, some of the areas which are some areas which could be of concern to a valuer communities, we have to continuously invest in training the team members, because the more trained members, so, and many times, I'm again with due respect, I'm saying there is a little dislike for people to spend time of 2 hours on Friday morning for getting trained and all that. So they feel this is taking away the time from assignments, and they will have to sit late and all that. So you find that excuses coming up and all that. But in the long run, this will always help you have trained team members. Attrition in the small and medium sized firms is the maximum, because we are the universities for the big firms. We train the people and people are picked up at 2 times, 3 times the salary. So you can't have any argument with that person also, because he's getting 2 times, he will go. So we have to be mentally be ready. We are universities creating the valuation community, but advantage of it is that after 20, 30 years of practice, in most firms you will find your own people. So because they are somewhere trained under you, so it helps. Competitive fee level. Somebody was mentioning 5,000, 10,000 people are ready to do. You are competing with a very, very tight. As I mentioned, company secretary, he has full secretarial audit practice. He will, to set up a valuation practice, he may charge fees which are very low. It is his choice. We can't stop him. But you are competing with him. There are many times somebody will say we are issuing shares, and we'll say suppose 1 lakh rupees. He says, but ये company secretary मुझे 10,000 में report देके दे रहा है, ले लो. So you have to decide which one to give up, which one to take. Regulatory changes, continuous changes, and continuous, it is bothering the valuer, because one day you prepare yourself for one regulation, suddenly something changes. Investigations. Now we are, firms like us, we are highly vulnerable for investigation. Again, investigation not bad. Problem is that one person, senior person, time goes away. You will lose 1 or 2 months of entire professional practice, because investigation, they will not work as per your schedule. I can't say I have a board meeting, I will come tomorrow. Tomorrow you are required at 11 o'clock. You have to sit there for 4 hours outside his room. And we are, with due respect, we are treated first as guilty. Then we have to prove that we are innocent. It is not that you are innocent and they have to prove that you are guilty. It's the other way around. So we have to be extremely careful. These timelines, for a larger firm, you will have a legal department who will keep on defending this. For a smaller firm, this is very difficult. If you are caught in a legal battle, it can be very costly, very long drawn, and many times, in most cases, client will not pay for that cost. So you have to be ready with that. Some fund, contingency fund you create in your organization. Now, how we create for housing societies as a similar multiple regulators. I think we discussed this, that we have so many regulators also looking at us. And lastly, valuation practice. There is a farming practice, which is auditors, taxation. It's a farming. Every year you do plow your farm, you get the fruits. In valuation is a hunting practice. You have to have a new hunt every day. You have to have a new prey every day. There is no fixed client. One client who was valuation done today, he may require you only after 5 years for some other transaction. Till that time, he will not even remember. He may reboot your name from his mobile. Only he will need some time after 5 years, 3 years when there is a transaction. So you have, what I'm saying is this is not a very fixed practice. Her point is right, very right, and I wanted to cover it at this time that it is a practice. So initial phase of your practice, you will have to have 2 or 3 areas which are simultaneously going. A day will come where you will have to drop one and then continue here, and at the end you will have to drop all and only do this. But first day you come and say only I will do valuation. For a small and medium practitioner, it will be a challenge because you may not get that kind of inflow that fast.
Assignment basis, if you value assign allocate us as a freelance.
In this area, to get an assignment is very difficult because you are dealing with a confidential work. Why should I part with my confidential data of my client who is a listed client with an outsider who is only a part-timer with me? Because I am bound by that agreement of confidentiality. You are not bound by it.
Agreement.
You can do it, but see, then in an investigation, this is going to be considered as negative that you parted the data to some Gmail account, unlike your own firm's website. So all these are points which I know how difficult it is to defend. So in valuation, you will not find many cases where you can say, I will come twice a week and I will help you. First of all, twice a week system will not work here because third day you will have morning meeting with the client. This guy is not coming only because he is coming only for 2 days. Third day you have to only bear the entire load. So in this practice, part-time is also very difficult because client emergency comes anytime. You have to have a person who is readily available within your system to help you. Otherwise, everywhere you can't run around. Well, friends, I sorry I have exceeded on Sunday afternoon a bit, but we went by the flow. So thank you very much for the interaction and happy to share any other questions maybe offline once we are done. Thank you.